Have you really paid attention to just how tough it has been? Well, we've got 4 big stock stats courtesy of the Worldwide Exchange team. Check this out. In December, 4 Dow names are down more than 10%. 10% of the S&P 500, 50 stocks, down more than 15%. Only 3% of the S&P 500, a lowly 15 equities, are higher. And 30 small caps in the S&P Small Cap 600 are down 25% or more in December. They've lost a quarter of their value. Let's talk about the macro markets. Let's talk about oil. Joining us now is Shawn Johnson. He is founder of Guidon Global. He's also a man who helped run a couple $100 billion at State Street for years?
2.1 trillion.
2.1 trillion. I really undercut you there, Shawn.
That's all right.
And by the way, a Virginia Tech Hokie, and we're glad to see you.
Thanks for having me.
So I want to start with oil because that's kind of what I like to talk about. But you put out a great piece recently to your clients showing the price of oil's decline. And we know that energy stocks, the weighting of energy stocks in the overall market has come down. It's only, 6 or 7%, but it's still relevant. How much do you focus on the price of oil from an equity perspective?
We'll look at it mostly from its impact on the sector of oil, but also on employment. It was a big driver in the employment for the last decade, and so it's very important to look at that relative to what the Fed's thinking as well.
Yeah, it's also an inflationary story or a deflationary story. Absolutely. Do you think that this collapse of the price of oil and maybe the collapse in the price of equities will change the Fed's decision tomorrow?
I hope not. I hope they stay the course and raise. Remember, the Fed's goal is really price stability and employment. The stock market in and of itself isn't a direct requirement, so I'm hoping they continue to raise tomorrow.
Why do you think they need to raise, Shawn?
We've had free money too long. It's time to wean ourselves of that.
Even if we have to go through this kind of pain?
I do believe that this is exactly what we're expecting. Last year, when I spoke to clients, I said, we'll likely go through a period of revaluation, and you may see both stock prices and bond prices falling.
Is this kind of a withdrawal? I mean,
it's a little bit of a withdrawal.
This is the night sweats.
Yeah, there you go.
How long is it going to last?
I hope they get us to about 3% of the Fed funds next year, and then I think it'll be more all clear after.
I mean, this stock market pain. Listen, I get it. It's been a great run for years.
Absolutely.
Okay, so you don't want to make too much of it, but when you see the stats that we just had, when there are 4 Dow components, these are the blue chips that have lost more than 10% in a few days. That's eye-opening.
Well, but look at what they've done over the last 10 years, right? You had also the valuation of the S&P 500 got almost to 23 times trailing earnings. The 100-year average is about 15.5 times trailing earnings.
If you're a 50-year-old viewer of CNBC, you're not investing for tomorrow or next week. You're likely investing for 10 to 15 to 20 years out, your kids' college. Make the argument to stay in stocks, though, now.
Well, I think it's probably, in some ways, a lower risk than bonds at the current valuation levels. So we'll probably see bond prices at the 10-year rise to about 390 maybe next year. You really want to stay in equities because you have the opportunity for higher returns.
Even if the dividend yield is lower than the yield on the 10-year?
Yeah, but do you really think anybody wants to own something that's only going to yield 3% for the next 10 years? That's not.
They look like it lately, Shawn.
Yeah, but that's not where I think you really want to be. I do think you want to own some equity exposure, absolutely.
How much, roughly, before we let you go, about how much do you want to own? What's a good balance?
It depends on where in the equities market. I wouldn't say broadly. I'm starting to like more the financials as they've come down so far. They look more appealing. The question is whether the Fed decides to lean on the long end of the bond market.
The financials probably want a rate hike tomorrow.
Yeah, well, if they raise the short end, I think they may have to accelerate the reduction in their balance sheet to drive longer yields higher.